So welcome everybody to today's webinar on the topic of bridge rounds. I'm very pleased to have as guest here Jan Engels, who is investment manager at Hightech Gründerfonds in Germany. And we'll dive into the topic of bridge rounds, give some real life examples, touch upon market trends, what we see from SeedBlink side of things, what Jan sees mainly in the DACH market and in Germany with HTGF having quite a broad view of the market. But I would like to allow him to introduce himself and maybe talk a word about Hightech Gründerfonds as well for the very few, I guess, who don't know you yet.
Yeah, thank you, Ronald. Yeah. Hello, everyone. My name is Jan Engels. I'm investment manager at HTGF, Hightech Gründerfonds or Hightech Founders Funds. So we are a private-public seed fund based in Germany. We have like 3 offices in Bonn, Berlin, and Munich. We are now around 19 years old, so which means we are more like an established early stage fund. We are currently investing out of our 4th fund, so which means clearly showed that we had certain traction and success in the past with our first funds. HTGF itself as public-private partnership, I mean the German government the state government is our largest anchor investor, and overall we are a rather broad team, and we invest also rather broad in industrial tech topics, life science chemistry, where I'm part of, and digital tech topics. So overall broad investment in the seed stage. A little bit about myself. I'm a scientist by training. I have a PhD in chemistry and nanotechnology. I also co-founded a medical device startup in the field of ophthalmology and drug delivery. So which means I clearly know the founder's side or the journey as well. And then I switched to HTGF on the investor side.
Cool. Thanks for that, Jan. My name is Ronald. I'm the regional manager for the DACH region. That means Germany, Austria, Switzerland for SeedBlink Group. I'm based in our Vienna office. And let's dive into the topic. We're talking bridge rounds. So let me start off by discussing what are we actually talking when we're talking bridge rounds and how does this compare to traditional funding rounds. And as a small primer and to put it into perspective, as SeedBlink, we are looking at anywhere between 2,000 to 3,000 decks per year and having 150 plus companies in our portfolio. Now, when we compare what happened 2023 and also this year, 2024, I think it's fair to assume from our statistics that 60+% of the rounds that we did were bridge rounds, probably even close to 70%. That obviously involves our own portfolio companies who need a lifeline to get themselves towards the next real equity funding round, and also companies that we haven't yet invested, but we're looking into basically participate in the small bridge rounds. But what actually the key difference between bridge round and traditional funding rounds? Jan, what would you say?
Yeah, I mean, in general, what from a definition, you can also obviously Google online. I mean, the normal typical equity round or the normal investment rounds, if you call it, let's say, from the seed stage, because pre-seed is sometimes some question marks. I can cover this in a bit. But from the typical, let's say, stage, let's seed stage for startups, then Series A, B, C. I mean, all this like alphabet numbers, sometimes up to like Series E. So the key point about equity rounds is that shareholder or investor will become equity, which means they are part of the company. They have real shares, a real percentage of the company owning it. And obviously, some slight differences if it's like in a typical German GmbH or let's say a Swiss AG. And on top of this, it's every time when you receive for your euro some equity, then you have a valuation or company valuation discussed as well. Because you have to obviously calculate how much you get for your euro. So every time on an equity round, there is a valuation of the company, but for a typical convertible or the bridge round, which is normally done via a convertible loan agreement, CLA, is often, it's like it says convertible loan, it's a loan, so which means kind of investors borrowing money to the companies, which means I think a big difference here is as well, we can discuss later on this, on also strategies, that there's no valuation in place.
Yeah, that's a good point. So I guess from our perspective, and I'm phrasing my lawyer here, he's always talking about priced and unpriced rounds. I think that's a fair comparison. And I mean, when we're looking at it from a DACH perspective, we tend to immediately assume that a bridge round is a convertible loan, a CLA convertible loan agreement. When we look at a bit more broader from a European or even global perspective, we see different means of bridge rounds. There is the SAFE, obviously, the simple agreement for future equity, which is getting some traction also in Western Europe, as far as we can see. And there is some specifics for certain jurisdictions, like an ASA, an advanced subscription agreement, which is a very particular thing you would see, for instance, in the UK. The SAFEs themselves, comparable to a convertible loan agreement, very American, because it was Y Combinator who came up with this whole idea. Slightly different conditions in there compared to a CLA. But I guess the fair point, and why we see so many bridge rounds, and that's why they are often called lifelines, is an equity round at the end of the day is complete once everybody sits at the notary and signs. Before that, because you don't know the shares that actually everybody's getting, that means you have to a lot of pieces need to fall into place, and a lot of investors need to be convinced and commit. The bridge round, on the other hand, allows you to do a bit more of a sequential fundraising. It's not always allowed, but oftentimes you can do a CLA of a couple of 100K with one investor, add another couple of 100K later on, so you can do it sequentially. And I think that's an important point. It gives you flexibility, especially in what is a tough market. And it's not an easy market for fundraising, make no mistake. So that's the first one. And the second one, talking about our beloved legal system, notaries and regulation, they are also easier to implement legally. Now, it has been back in the day that lawyers would tell you you can do a convertible, say in Germany or in Austria, without going to the notary. If you ask the same lawyers today, I think 50% will tell you, to be on the safe side, you better do it in front of the notary. But it's still the case that CLAs, convertibles, are done without notaries. So I guess that's a bit of a difference. Having seen a lot of convertibles done this year, and I guess the same holds true for you, Jan, is there any trends you see in the market? Meaning, when we put it into perspective, 2021, 2022 were the heydays of venture capital. It was irrational exuberance in hindsight. We have a market correction since 2023. It goes all into 2024. Do you see any trends that emerged when you look at bridge rounds, when you look at convertibles over the last, say, 1.5 years?
Yeah, I mean, I completely agree. I mean, like the heydays are definitely over. I mean, it's based on the general economical situation globally, but also in Europe and Germany, in the DACH region, and also kind of tied or linked to the central bank interest rates, which hopefully already came down a little bit. So it's all actually, I mean, the VC space, the startup space is actually quite linked still to the traditional financial markets, because at one point, I mean, also VCs or bigger VCs need to raise their funds capital. And definitely, I mean, we see, because the market is rather tough for startups, and let's say they received already a seed financing round, let's say 2 years ago, 1 year ago, then definitely we see more and more upcoming so-called bridge rounds. Sometimes, obviously, some startups try to paint them with a different name. Is it like a seed extension? Is it a pre-A round? I mean, at the end, but still typically what we see, what it is at the end, it's a bridge round. And the bridge round, at the end of the definition is really, okay, when a bridge round takes place, that a startup, let's call it, let's say HEGF typically invests in a seed stage. We normally look at least for a runway from 18 months, which means close to the end of the runway, then normally startups go into fundraising for their next round, their Series A. But as the market is really tough, it's not too easy to raise a substantial, let's say, Series A, especially, let's say, in the medtech space, where I'm a little bit more involved, is, let's say, a 10 million euro Series A. Yeah, there are a few options. Okay, well, what we do now? I mean, we have the first discussions with investors, but actually we can't, in the next, let's say, 4 months, we can't close a Series A, because, Ronald, as you said, I mean, you need to bring everyone on the table. You need potentially, like, let's say, the full commitment or nearly full commitment of, let's say, a 10 million round. You need to align on the valuation, on a lot of terms, and then you need to go to the notary, signing it, typical German bureaucracy until there's really the time, like the money can be deployed on the startup's bank account. So it all takes time. And this is a situation. I mean, I have it actually in my active portfolio. We are currently discussing, okay, there are some interesting due diligence with Series A investors, but what about the runway currently of the startup? What would be at least a plan B? And the plan B is normally every time a bridge round, which means we are bridging. It could be from a couple of months. It could be up to a year. So that is like really individual, like based on the maybe traction of the startup, the situation. If it's really close to signing a Series A and need, let's say, 2-3 months runway, I mean, obviously that is a different story than the company really needs money for, let's say, at least 12 months. But obviously also, let's say, I think that is also the VC style or habit. I mean, we're all optimists. I mean, we are investing in the future. So normally, I mean, definitely we are looking very optimistic and positive into 2025.
Yeah, that's a good one. I mean, the thing is now we're focusing on convertibles because I think that's the product of choice or the instrument of choice, so to say. And when we look into convertibles, I mean, there's basically 4 parameters that count, right? There is a discount, there is a cap, there is an interest, and there is a maturity. If investors, and it's oftentimes existing investors who want to help the startups because they are incurably optimistic, as Jan said, they want to have their risk rewarded somehow. And the risk rewarded is often done by a discount on the next valuation. So an investor signs the CLA, the convertible loan agreement, but expects something in return for taking this risk. And that is usually, I get the shares cheaper at the next financing round. And this discount at what we currently see is ranging anywhere between 20 and 30%, depending on how much trouble the startup is in. And the second one is also because the discount gives you obviously a better price for your shares, but you also want to make sure that you have at least a certain rough idea of where the next valuation could end out, and you're not buying yourselves into too expensively. So the combination of a discount and the cap, which is a valuation cap for the next financing round, is kind of 2 parameters that we consider very important these days for investors. So there has been in the past, so 2+ years ago, there have been convertibles without the cap. I don't see them anymore. Investors ask for them. They want to have full security. They want to have discount plus cap. I think that's a market trend that I see. The interest part side of things is an interesting one because historically, as far as I can see, the interest was the least discussed topic in a convertible, because in a zero interest environment, why discussing interest? So they have always been quite low, 2%, 3%. Now, ever since the market rates increased, you do see a correlation in convertibles as well, which is interesting. So there is a correlation here as well. So we are rather aligned with the 6, 7, 5% ranges that you see in the current market. So this is also a trend that I see over the last 1.5 to 2 years. And the last point, the maturity. So how long would you want this convertible to run before it gets either converted or basically it gets converted, it never gets paid back. And if you look at a couple of startups from the past, you sometimes see maturities of convertibles 5+ years, which is ridiculously long. This has completely changed in my view. So I think the max that you see nowadays is 2 years, and that's already a stretch. So anywhere between 1 and 2 years. Would you agree with that? Yeah.
Yeah, I mean, totally. I think we clearly see the very kind of same variables. I mean, on the one side, I mean, the interest rate, yeah, it's very interesting that we see it increasing, but it's often also especially sometimes public investors in Germany or HGGF is a public-private. I mean, we definitely have a look on, let's say, what interest rates are in the financial markets. And obviously, when the main interest rate from the central banks or whatever is higher, we kind of have a look on those. Obviously, money-wise, yeah, when you, let's say, put down 100K, 200K, it's not really too big money you're making. Let's say if you convert it after a year, it's a few thousand euro, but still, I mean, there's definitely there is a reference on the typical financial markets. Discount, yeah, I also would say the average is a typical 20%, and this can really shift from super aggressive. I mean, where companies are maybe close to bankruptcy, where it can go up to discounts 50%. That is really I mean, when there's the last life line for a startup, I mean, they would accept those terms. But sometimes, I mean, we can also talk about some positive bridge rounds. I mean, the actual some scenarios, or I wouldn't actually call them really typical bridge round because maybe they are not needed, but convertibles, which much lower discounts, let's say 10% or 15%. This is more some other scenarios. The cap definitely, I mean, the point is what I think, yeah, the cap is really critical. I mean, about, yeah, having in which, let's say, valuation you convert your loan. I think for those who maybe don't really know what is a cap because there are some question mark about it. Giving you an example, the company want to raise a, let's say, 10 million round Series A, and they need, let's say, a few more months runway. I mean, on the one side, the cap means when, let's say, some investor, seed investor, putting some 100K out there in a convertible loan, that the question is, okay, at which valuation that they would convert the loan into shares. If suddenly the valuation, whatever reason, jumped to 100 million pre-money, then obviously this whole discount, and I mean, the 100 to 100K euro invested would be like in a share percentage should be really like 0.1%. So which means that is not of the interest of those going into the potential risk with a bridge round or CLA. So they want like kind of cap their downside as well, their dilution factor. So definitely caps are more and more common, and I mean mostly it's normal. And maturity, we see it the same. I mean, can be sure depends slightly on the situation. When you clearly know in the next six to 12 months, you would anyway convert because you're really going straight to a, let's say, Series A round. But more than sometimes I saw like 3 years, but normally it's more really on the lower time frame and not about the like whatever 5 years. And those times are definitely over, yes. Because also I think it's more difficult to raise around. So I think those investors don't want, let's say, their loan in the worst case have it there up to 5 years when the startup can't find a proper next financing round.
Yeah. Yeah, so the cap is an interesting one. It's a double-edged sword, to be quite frank as well. Investors will ask for it in the market. That's for sure. For exactly the dilution reasons that Jan just lined out. At the same time, it has a signaling effect. Let's be quite clear. And that's why the maturities get shorter. So maturities we see 1 and 2 years, 1 to 2 years, so 12 to 24 months, because we expect that then a financing round is supposed to happen. Now, when you're thinking about as a founder up towards the next financing round, then you want to set the cap at a reasonable level, i.e. it has some signaling effect for the equity investors that might come in the next round and ask for the convertibles and look at the cap, because this gives an idea what the founder considers reasonable and fair valuation. So that's not to be underestimated. I just wanted to mention that. And one more point on the interest, just to be clear for the listeners here who might not have done any convertibles. The interest itself is always paid in kind, so it's never paid in cash. So it accumulates and then it's basically added towards the investment, and then the investment is converted at a certain cap or discount. It's important to understand interest is not gonna get paid. There's no money cash outflow during the maturity of a convertible loan. When would you consider, we touched upon it a bit already, but what's a typical scenario, maybe even a concrete example that you have seen this year when a bridge round was considered? What's a typical scenario?
Yeah, I mean, the typical scenarios are mostly more negative, I have to say, because the point is, I mean, as I said, I mean, the founding team after the seed round looking for additionally funding, the market is tough. They can't find really good follow-up financing for a Series A. And yeah, at one point, yeah, which is very normal. I mean, they run out of cash. So I think the existing investors really need to think about, okay, what is now the situation? I mean, is it really like really difficult and no follow-up investors talking to the founding team, or is it more about, let's say, a couple of months runway, additionally runway? And I mean, we see both scenarios. I mean, definitely there are those bridge and the bridge of the bridge and the bridge of the bridge of the bridge. I mean, this is also actually happening because, I mean, what investors don't like is losing money, to really say, okay, I put down substantial investment in the company and then they go bankrupt. So I think often investors tend to try or have the hope. I mean, we're all optimists that the company at one point will change the strategy, maybe get finally a big customer, have a breakthrough in the technology side and so on, or go viral, whatever it is. So I mean, as investors are quite optimists. I mean, it's obviously it's one of your portfolio companies. You try to really bridge the next rounds and the next rounds, and so this really depends also on the one side the parameters of the CLA. Again, the interest rate, maturity cap, etc., and how like optimistic or maybe also pessimistic the investors are. So it's really like depends, boils down on the situation. What I mentioned before a little bit on the positive side. I mean, what I saw, or a scenario where it can be actually a positive case. Let's say the company running out of cash, but actually there are some kind of gold on the horizon, which means they are very close to some clinical data, nearly finalized their prototype. And it's more really on the timeline where it's like they could hit a really strong value inflection point. They finished their scale up. They have some, again, scientific proofs. They hit a certain revenue, let's say, when you're more on the maybe industrial tech side or digital tech side. Let's say they hit the first 1 million ARR, etc. So I mean, and this is like a strong value inflection point where, let's say, the valuation of a company would substantial increase for the next one. So that is a positive scenario where like investors say, okay, we chip in a little bit more money for, let's say, half a year, or maybe up to 1 year, and based on those new results, the new findings, the new positive news or big news, let's say in the field where I'm active, let's say clinical trial results to cure, let's say, cancer. I mean, this is of course not the easiest, but I mean, if there's a really big positive news on the horizon, then it's often a very positive or optimistic that the investors chip in a little bit money, collect the value inflection point, and then hopefully raising the next round, like with a much bigger step up for the next financing round. So this actually also currently in one of my portfolios companies happening where the existing investors chipped in money, that we have a little bit longer runway, but in this runway we can really achieve, or the team can achieve, substantial milestones and value adds for all the existing current shareholders.
Talking about milestones and reaching inflection points, those can be obviously inflection points that increase the valuation, which in your case is often, as you say, clinical data or these kind of things. In a classical SaaS startup, it's obviously reaching certain MRRs, certain ARRs, these kind of things, so traction at the end of the day. Have you seen, we're talking about milestones, have you seen any convertibles being attached to milestones? Like you get the first batch if you achieve inflection point X and the second batch if there's inflection point Y, just out of interest?
We saw it. I mean, it's most common, and for us, for our equity rounds, it's standard. I mean, for our equity rounds, actually, it's all milestone based, especially in this really early stage where I mean, it's sometimes also need to guide the founders. For convertibles, is less often because I think the money is not so substantial that it's mostly really paid out in once. But I saw one occasion definitely like also like a little bit bigger bridging round, and then I also saw a milestone that they should hit some value inflection point, and then they would have again more capital from the CLA. I mean, the other part is sometimes, I mean, it's also I had one CLA which was a, you can call it, positive bridge round, again to just have a little bit more runway, where also the founders can decide how much they call, like capital call. So which means let's call it few hundred thousand. I mean, it was a bit below €1 million, but then the key point was, okay, how much they finally at the end need. So it's again double-edged sword, right? I mean, it's kind of the company, the founders kind of borrowing the money in the CLA from the investors, and it makes a difference if they borrow only 200,000 when this might be enough, or maybe $500,000 or up to $1 million. So there's also a point where I saw that, but this is more when the founders are in general on a more strong position that they can decide how much they borrow, because at the end I would like to chip in again, let's say 200,000, but and as an investor, but the founders just call, let's say, a fraction of it. Obviously, that is somehow a little bit disadvantage for the investor side.
Got it. Yeah. And talking about we're very much focused on portfolio companies, right? And you said beforehand already, investors basically, investors slash shareholders, they believe in you. They are optimists. They want to bridge you towards the next round. So who is funding the bridge round? Is it exclusively existing shareholders, existing investors, or do you also at times see, say, a bridge round that might be partly funded by existing shareholders slash investors, but also new people coming in to come in with this idea, okay, I can get into this startup, which is interesting for a cheaper price in the future? Is that something you see?
I mean, definitely more seldom, and normally it's that existing investors thinking how much they can chip in. If it's really crucial to get external money, obviously the founders also should really go out and have a look. But I still think if it's like substantial new money, let's say from an institutional investor, then you will go some routes like, again, naming it, I mean, first of all, an equity round more likely, but then naming it seed extension, pre-Series A, something like this. If it's like an angel who chip in let's say, new angel investor chipping in from 50 to 100K, I think that is a different story. But if it's really institutional investors joining or really want to join, then I think there's a preference for everyone in the round, for existing shareholders, founders, but also the new investors to put on a price tag on a round. I mean, also for existing investors, it's also beneficial when there's a hopefully step up price tag in the equity round. So yeah, for a CLA, I would say angel, yes. Institutional investors, then I think you go for equity round.
Yeah, understood. Yeah, that's what we see as well. I mean, at the end of the day, a bridge round is, in the vast majority of cases, done by the existing shareholders. We do see every once in a while, and we have done it as well, quite frankly, that small investors are joining the round for the reasons that are outlined, getting into cheap and willing to take the risk. So that's fine. But you're perfectly correct. We're not talking huge sums. We're talking angel tickets, obviously, anywhere between 50 up to 200K, these kind of things. Okay, good. Our last topic before we go into the Q&A, we talked about the various parameters that are tied to the convertibles. Obviously, this has an impact once there comes the next equity financing round, which often is then called a qualified financing round in convertible loan agreements. So founders need to think carefully on how they put these parameters, and the most important being the discount, the cap, and to a lesser extent, the interest, because that will impact the cap table. Now, this is important when thinking about how to structure the bridge round and to avoid too much of a dilution in the future. And obviously, as I said beforehand, also you need to be careful because especially caps have some signaling effect towards future funding rounds. But there is a cap table impact, and this shouldn't be understated and needs to be assessed. I do see it, especially with early stage founders, that their prime goal is obviously keep the company afloat, keep the company alive, and they don't care so much about the parameters, kind of neglecting the fact that they could run into a poison pill scenario, which means they couldn't run into a scenario that the next equity financing round is going to wipe them out too much on the share side of things. Is there any examples of these you have seen in the market, maybe good ones and bad ones, Jan?
I think the benefit you can see, like from a founder's perspective, that founders are nowadays much more educated. I mean, you can find so many materials online. I mean, they can educate themselves. Okay, when they suddenly don't know, let's say, what is exactly a CLA, how it works, and all those parameters. I mean, I also recently read an article about those typical caps. What is like, as you mentioned before, a double-edged sword. So definitely, I think that's happened more seldom. I mean, I think founders are really more aware of, let's say, how a CLA impact. So one of my portfolio company, they would have for a CLA, actually, we could ship in more, but they clearly wanted to have a, let's say, cap the CLA itself. Let's just give an example. We would, as existing investors, would put down 1.5 million, which is quite substantial because the company developing well. It's like, in this sense, it's really about hitting some more additionally milestones, extending the runway a little bit. But the company or the founders clearly wanted to have a maximum CLA of 1 million, because they are really aware. I mean, when you think about it, let's say the typical 20% discount, which means somehow the investors indirectly would invest 1.2 million, and there's 6% interest rate. Let's call it really 1 year. I mean, you can really add it up, and at the end with the discount and the interest rate and so on, it would be kind of the investors chip in 1 million, and actually it's somehow indirectly as if the investors would chip in 1.3 million. So definitely, I mean, I think on the positive side, founders are more and more aware, and including the cap. So nowadays they can also some better, some worse, to calculate the cap table, in which, let's say, potential valuation, let's say Series A valuation, what would be the conversion rate, and exactly. I mean, in the worst case, I mean, especially if a bridge round or CLA is very aggressive, let's say 40-50% discount, this and that. I mean, definitely this can then easily, when it's converted, really dilute the founders, especially the founders, quite a lot. Or also sometimes those co-investors who didn't participate in a, let's say, bridge round, in a so-called bridge to nothing. Normally those are those with very aggressive conditions, where it's really the big question mark in which direction it goes with the startup. The bridge to nothing, where often like another bridge is following, then the conditions will be more and more aggressive. And when you have then those much more interest rates, plus 10%, 40-50% discounts, whatever it is, then definitely, I mean, if those are converted, then mostly you can see that, yeah, the founders will be diluted, often definitely below 50% shareholding. And this is obviously a very critical, you can call it, milestone. Obviously, in very companies or startups running very well, you go for a good seed, a very good strong Series A. Obviously, in one point, I mean, they also will have less than 50% shareholding, but then mostly, I mean, there are the nice step ups of the valuation of the company. But again, on the bridge rounds and the conversion, then mostly down rounds, flat rounds, etc.
Yeah, that's an important point, and I would like to reiterate. I think the key message that I would like to give founders, and that we give to all of our founders, is do yourself a favor and do run the simulations. Whether you do it in Excel, which is mostly the case, do yourself the favor and run simulations of what you expect the next financing round going to look like, assuming you do the CLA at certain parameters now. It's very important to do that. The reason why I'm saying this is the first 100 financings we have done, we obviously replicate cap tables. It's a bit of an annoying task to do, but what we found out, and I hate to say it, like half of them are wrong. They're not fundamentally, but there's always some errors in there. And that's why this is a bit of self-promotion. We are now having a software platform up and running, which you're free to use on our platform. You can put your cap table in there and do yourself a favor, run the calculations, run the simulations to see where you end up, and see whether it makes sense to get a certain convertible at a certain amount at certain parameters. It's very important. And make sure the cap table is calculating properly. Okay, so cool. Having said that, I guess we go to the Q&A session, and we have one question here that says, could we still say that the gap between pre-seed, in brackets own funds, and seed, in brackets public funds, is a bridge round? That's an interesting question. I'm not sure if I fully understand that.
I mean, maybe. I mean, the point is here, I think, between a pre-seed round, I mean, here in this situation is own funds, which means like seems to be self-funded in a very early stage, and the seed public fund. I mean, if for the seed you only receive public funds, I mean, the question is if you would, I mean, there's also sometimes the debate if you would call it a funding round at all, because it could be that at one point you get public funds, which means non-dilutive money in the company. I normally wouldn't call it a seed round, and I also wouldn't call it a bridge round. I mean, this is more normally how I see this type of startup. It's like your bootstrap, you're self-funded. I mean, the founders put their own hard-earned money in the company. Then you receive additionally public funding, non-dilutive funding. So it looks, at least for me, that the cap table should be quite clean, that only maybe the founders or maybe also a university institute or whatever it is might be part of the cap table. But normally I don't see here any so-called bridge round. The point is on top, maybe to add here as well. I think if it's really bootstrapped by yourself, by your own money, you don't need to at any tech. I mean, if it's also not a pre-seed, maybe it's family, friends, and fools money, like the 3F, FFF. But normally you still could go, let's say, maybe for a convertible with real, let's say, external investors, angels, or maybe a smaller VC fund. You could still go for a CLA to get a little bit runway to the maybe seed rounds, something like this, or Series A. So, but I wouldn't call this scenario bridge round, because you are not really, yeah, I mean, I don't see the bridge, because I don't see substantial funding rounds here. So to start with, hence, can't bridge from no funding round to another funding round.
Yeah, I guess well spotted. And the next question is, we as a startup offer convertible loan from which legal entity, question mark? Should it be a joint stock or could it be done from an LLC? Whoa. Okay, now I need to confess I'm not a lawyer, but I can tell you what I have seen. So obviously in German-speaking countries, we often see GmbH questions, GmbH legal entities. We see stock companies to some extent, more in Switzerland than in the other countries. And in Austria, we now have the Flexco, which is the new company legal form. All of them I have seen issuing convertibles, and all of them I have seen not having legal problems or regulatory problems issuing CLAs. I cannot comment honestly on the LLC. Not sure about you, Jan. Not really.
I'm also not an expert on these. I mean, typical the DACH region GmbH or AG. So it's hard for me to really answer on this correctly based on my knowledge.
I mean, what I can add though is, and I mentioned it at the beginning, that especially in the UK, where a lot of companies are Incs, incorporated as Incs, you see a lot of advanced subscription agreements. And that, according to our lawyers, as far as I understand, that has legal and regulatory reasons why you see less convertibles, for instance, in the UK, and more advanced subscription agreements. But this is all I can add, honestly speaking, to that topic. Okay. One further question that I received bilaterally. If I have 5 angels backing me in pre-seed and 1 VC in seed, where should I go for a bridge round between the 2 categories of existing investors? That's an interesting one.
I can't see the questions.
No, it's bilaterally. So I have 5 angels backing me in pre-seed. I have 1 VC backing me in seed. Whom should I approach for the bridge round between those 2 existing investor categories? So 5 angels on my cap table and 1 fund sitting on the cap table. Okay.
I mean, normally I would go for the bigger money, which is the VC. I mean, there's definitely I would, yeah, because I mean, also the chance that a VC, I mean, normally the VC should have the most, I mean, from an investor perspective, the most shares. You should communicate with the VC because they have more deep pockets. It often happens also that angels can't chip in again for a bridge or whatever the next round. I mean, it's some telling me as well for in one occasion that, yeah, I mean, one small angel said, okay, once he wanted to invest in a startup, he don't have more money to put in this kind of high risk capital, but definitely every time go for the institutional investor, the VC.
Yeah, I think to add to that point, I think it is important that the big pocket money that is sitting on your cap table already is convinced and joining the bridge round. In order to make it worthwhile. So without having your existing shareholders committed to the bridge, I think it's almost impossible to get a bridge from the market. I think I would personally say yes, like go to the higher liquidity pockets like a VC fund. If you have one on the cap table, ask the angels if they're on your cap table as well, whether you want to participate, if they still can financially. And you might add a third external tranche from some small investors as well. But this is really under the assumption that your existing shareholders are in. If they are not in, don't even bother, because it's like nobody will buy into a dead horse. Sorry, excuse my French. Okay, one more question. In the context of a startup formed from a propco, IP rights, and an opco company, business operation, which is more attractive for VC funds for seed bridge rounds? Propco versus opco. Propco holding IP rights, opco holding the business operation.
I mean, normally it's, I mean, we only invest where the IP lies. I mean, it's like, I mean, they are the, especially in the early stage, they are the assets, and we only can invest in those, yeah, where the IP is finished like that. I mean, that's normally, no one would normally invest in some operation holding because there's no value. And there's stuff, which means they're mostly burning money, so there's no really value add, or no value in the company.
I think especially if you're early stage company, keep it simple and basically have one entity that is doing the fundraising and where you have IP and operations. I mean, that's usually how it works. I mean, it's not often that you see that the early stage companies are branching out into subsidiaries and stuff. It might happen once you go into the M&A game, but before that, I don't see that quite often, quite frankly. Okay. Any more questions? Last questions to Jan or me, for that matter. Not so far. We have answered the questions we had, and we don't want to make it unnecessarily long. We will send the recording to everybody who registered for this webinar, also the people who could not be here. I mean, we're close to Christmas. Everybody's busy. So is Jan. That's why we'll leave him here. Thank you very much indeed, Jan, for your time. Highly appreciate it. Thank you very much for joining, and have a festive holiday season. Get into the new year healthy and happy.
Yeah.
Thank you very much.
Thanks,
Take care,
everyone.
everybody.
Have a good day. Bye-bye.